Hi, I'm Richard Vague with Tychos. On October 3rd, the Financial Times reported that over 2.9 million people had applied within a 48-hour period to bid for a single apartment in Hwaseong, a location just outside of Seoul, South Korea, highly coveted by parents for its access to the country's best education. This astonishing figure highlights the extreme demand for housing in that region, but it also reflects a larger issue: South Korea's growing reliance on real estate investment and the alarming rise in private debt in that country. Now, we normally focus on the top 7 economies in the world, but when we see a statistic this stunning, it typically portends trouble of some sort, so we thought we would dig a little deeper. South Korea is consequential globally. It stands as the world's 13th largest economy, edging ahead of Mexico and Australia, and nipping at the heels of Russia, Canada, Italy, and Brazil. And it boasts such worldwide brands as Samsung and Hyundai. But South Korea's private sector debt has risen to alarming levels and now stands at 204% of GDP, as compared to a significantly lower 149% in the U.S. The 5-year growth rate in private debt to GDP in South Korea managed to reach an eye-popping 21% in 2022. And while growth rates have trended down slightly recently, they still remain high at 15%. And we view the threshold of concern to be around 15 to 20%. The last 2 peaks in private debt growth in South Korea were the mid-1990s and the late 2000s, which led respectively to its Asian crisis of 1997 and its part in the global financial crisis of 2008. The up and down of South Korea's housing price index is dizzying. Hwaseong is seeing a frenzy, but some less desirable locations in that country are seeing a glut. Its housing price index reached a peak annual growth rate of 16.3% in October of 2021, and then collapsed all the way down to negative 7.4% in July of last year. While that annual growth rate remains at a negative 0.21%, it has percolated up slightly since July. We would hasten to note that no Asian economy has near the housing imbalance and glut that the state-directed economy of China now does. A key contributor to South Korea's recent softness is that its fertility rates are down to a very low 0.7 births per woman, well below the required replacement level of 2.1 needed to maintain population growth, and thus its population is now actually declining, mirroring the same troubling phenomenon in China and Japan. The rate in the U.S. is over twice that at 1.6. Its population peaked at 51.9 million in 2020 and is now down slightly to 51.7 million. And the median age in South Korea is all the way up to 45 years as compared to 38 in the U.S. and 28 years in India. Ironically, as far as housing goes, that population decline impact has been partially offset by a rise in single-person households, which is not a good sign for social cohesion. Meanwhile, gross fixed capital formation, essentially the country's investment in long-term assets like real estate and infrastructure, makes up 32% of its GDP. For comparison, China's investment is at 41%, which explains, by the way, its overcapacity dilemma, while developed economies like the U.S. and U.K. sit at 21% and 18% respectively. This heavy reliance on investment, particularly in real estate, mirrors the kind of overbuilding and debt-driven growth we've seen elsewhere, though it is not near the kind of absurd excess we see in China. Like China and Japan, South Korea's ace in the hole has long been its strong net exports, which reached a high of 7% of GDP, really an astonishing number, and fell all the way down close to 0% in 2023. However, in the past 2 quarters, they've made a comeback, and that surplus now sits at 3% of GDP. Strong net exports can be a saving grace for highly indebted countries. Once those fade or soften, trouble often follows. For their economy's sake, they need to maintain a strong trade position. Bank of Korea is caught in a difficult position, kind of like the rest of the world is, frankly. If they cut interest rates to stimulate short-term growth, they risk inflating the housing bubble and exacerbating the household debt crisis. On the other hand, keeping rates steady or raising them could make over-leveraged homeowners and companies, for that matter, vulnerable, similar to the U.S. in 2008 when many mortgages went underwater, leading to significant financial strain on households and lenders. Add to that the fact that many young South Koreans are delaying or avoiding home ownership and family formation altogether due to high housing costs and the burden of debt. With South Korea already having one of the lowest fertility rates in the world, this trend could exacerbate the country's demographic decline, leading to further strain on the economy and social services. High private sector debt, declining population, and a challenge to its trade surplus. South Korea seemingly has it all, and its real GDP declined to 1.4% in 2023 from 2.6% in 2022. While growth has picked up a bit recently, reaching 2.25% in the second quarter of this year, it's frankly going to be very hard for South Korea to sustain solid economic growth in coming years, and we're likely to see a rise in credit problems both in its corporate and household sectors. Even vaunted Samsung is seeing cracks in its earnings facade. That's it for this week. Let us know what you'd like to cover in the comments below. Thanks as always.